In Friday's video, I asked the question is why was Bitcoin trading so ragged given that M2 is hitting all-time highs? And thank you for all the comments. Everyone had their opinion. It was great, all across all 5 platforms. This is what I'll say about that. This was not about Bitcoin. This was about liquidity in the market. To me, Bitcoin is a function of liquidity, and if it's trading down, something must have happened to liquidity. And so I want to go quickly over what's going on in Japan so that you understand what I was trying to say. So first, the government, US government, the Fed, signed an agreement with Japan on a currency swap, that they would swap Japanese yen for US dollars so the BOJ, the Bank of Japan, can give the dollars to their institutions. Their institutions are just like ours. They're invested all over the world. When you invest all over the world, guess what? You're investing in dollars. So if they're a typical institution in Japan, they are highly, highly leveraged beyond comprehension. All the institutions are, okay? So when the interest rates in Japan went up and they're holding the 30-year, the 20-year, and the 10-year, like we said, down goes the prices, incurring margin calls. But these margin calls are across the world in dollars, okay? And so the BOJ can't give them dollars, they can only give them yen. That's the only thing they can print. So they cut a deal with the Americans, they give them dollars for the yen so they can give to their institutions. Now, we know as of Friday that Bank of Japan intervened 32 times in 29 days. What do we mean by that? Pretty simple. They're having margin calls, so they need dollars. So the 32 times that BOJ intervened was intervened to give the institutions dollars to satisfy where their margin calls were. Now, the Japanese in total own, I don't know, 2 trillion to 2.3 trillion. We'll go with 2 trillion. And I think we're pretty sure 1.1 trillion is in US treasuries. Now, if they were selling their treasuries because of their margin calls, I think we would have heard about that. I'm not sure, but there's been no noise on that. But they do have $900 billion in securities. And that securities, maybe some of it, not all of it, is being liquidated so that they can reduce their position so they don't, how do you meet a margin call? Either more capital or you sell. They're your only 2 choices. So we know that they're going for the capital at this time. Why is this something we need to watch? Well, think about it. There's been 32 interventions by the BOJ in 29 days, meaning that the Japanese are asking, the institutions are asking the BOJ to give them dollars. Now, the BOJ has told them, hey, you can use pooled collateral. What does that mean to us? That means that they're really hurting, okay? Because if you have stocks, we give you 50%. If you have BOJ bonds, JGBs, we'll give you 99%. You have CMBS, we may give you 80% or 70%. If you have derivatives or whatever it is, there's percentages that people give them. So what the BOJ says, pool all your assets. And if we pooled all those assets, let's say it would come out to that we would lend them 65%, making it up. And the BOJ says, because they're pooled, reduces the risk, we'll give you 80%. That's why pooled assets also tells us that this is a much bigger problem than people are saying, okay? Now, 3 years ago, or 2.5 years ago, I did a video when we were talking about the yen initially, and I said, look, there's 2 countries that we have to watch as, let's say, like canaries in the coal mine, and that is Japan and the UK, Britain, okay? These 2 financial profiles tell us that they could be an issue for the global financial system. So we just kind of went over to Japan. What do we have to worry about on Japan? Is when they run out of collateral, pool collateral or whatever, and then they literally have to sell. So right now, they have 2 choices, get capital or sell. If they run out of capital to give to the BOJ, they have to sell. All right, so what's going on around the world. So El Arian in The Economist wrote this article, and this is just a piece of it, all right? In the second paragraph, it kind of like sums up this sovereign crisis that is coming to the Western world, all right? And what they're saying, the average fiscal deficit in the OECD is the club of the most rich countries, hit 4.6, up from an average of 2.9% 4 years before COVID-19. Interest payments on outstanding debt came to 3.3, just below the NATO members' hope to spend on defense by 2035. And so he goes down here and he calls it the deficit-populism doom loop. Ministers face both big deficits and voter revolt, and there is little way of satisfying both the bond markets and the barbarians at the gate. So what's he saying? Think about what we're going through. You know, deglobalization's over. We're now redoing our supply chain. People have to spend money on defense when they didn't have to before. They have to spend huge money. Look at us on REM. We're going to spend billions and billions on that. Lithium, billions and billions. In other words, all the countries have all these new demands because deglobalization is ending. Plus, America has decided to go out and tariff everybody, which is slowing down their economy when their deficits are still going up. And so what's the effect that we've seen across the world? Or I shouldn't say that, across the Western world. So here are the 30-year government bond yields for the US, Germany, Japan, UK, Italy, and Spain. All of them are moving up. Remember something, everyone's cutting interest rates across the world. The US is about to start, I think, in September. Again, if you know what we know, I don't know if we should actually do this. So look at the English here, the UK. UK is in yellow. You see them up there, gold or yellow? They're number one now. They just went, I think it is a 55-year high on their 30-year bond, okay? Remember that. But in the past year, the UKs have cut their interest rates from 5.25% to 4%. They've had 5 cuts in the last year. You can pick it out here yourself, but it looks like they went from 4.25% to 6% on the 30-year bond. Think of that, 5 cuts and the bonds went up. Now this is what we've been saying on this channel for 2 years, that if we mismanage our rate cuts, we could see this happen to our bonds, all right? And by the way, we're in black. Look at our bond prices, bond yields, they're going up. But that's one side of the coin. The other side of the coin is, so your bond yields are going up, but look what's going on with your bond prices. Look at Japan. We just talked about this. What do they need money for? Because their bonds are down 14.9%. They're all going down in price, which is putting pressure on all the institutions that own them. So all the trades around the world are being affected by the bond prices going down because sovereign debt, let's be honest, if you're a big institution or whatever you are, you have sovereign debt as the core piece of your portfolio. And here you have the gilt. It hit I think it's 6.2 or 6.3 right now, okay? It's showing that's the highest since 1998, 27 years. This is a big deal. And remember something, look back here in 2024, they were around 4%, so they're up 1.6%, even though they cut their interest rates 5 times. So here's the populist doom loop, okay? And let's look at France. France cannot get a government in. The right or the left will not work with the center to reduce some of the benefits and increase taxes there. And some of the benefits are like crazy, like their retirement age was supposed to go from 60 to 62, and no, not happening. No cuts whatsoever. So all these countries is, populism is saying, no, we're not gonna allow you to reduce our benefits for whatever reason that they say, okay? And these is what's happening. So we're in a little better shape in America, but we're faced with the exact same thing. So what do you think's gonna happen? What should we do? Tell me in the comments and like and follow. Thank you for listening.